Hello, this is the lecture for Chapter 2 in Managerial Accounting, which is called The Building Blocks of Managerial Accounting. So at this point, you watched the overview lecture for Chapter 1, and now we're going to dig down a little bit deeper. So in this first objective for this chapter, we're going to distinguish among service, merchandising, and manufacturing companies. Now, in your first accounting class, you did brush up amongst the different types of businesses, and we spent a lot of time in service-oriented businesses in accounting, 201 or the first level of accounting. So this time we're going to go just a little bit deeper. There are three types of companies: a service business, a merchandiser, and a manufacturer. So let's talk about each one. Service companies provide a service only. There's no inventory, and some examples are accountants, banks, doctors, lawyers, consultants, independent contractors, anything that provides, a cleaning business, anything where there just isn't any inventory and all they're doing is providing a service. A merchandiser is a reseller. They resell products purchased from suppliers. There's one inventory account, and examples are like Amazon, Penny, Sears, any of the big box stores that you can think of. They're reselling product from another place. There's retailers and wholesalers that are merchandisers, so just keep that in mind. We're more familiar with retailers, but there are wholesale businesses that are merchandisers too. Then there are the manufacturers. They use labor and other inputs to convert raw materials into finished products. So we spend a lot of time on figuring out what costs to put into our product and to figure out what price we want to sell it for. Examples are Crayola crayons, Dell computers, Craftsman tools, anything you can think of that the manufacturer is making something. Toyota, any of the car manufacturers, there's tons of them in the world. They have three inventory accounts. They have a raw materials, a work in process, and a finished goods. So if you step back and think about it, whatever you're making starts out as nothing. So you bring together raw materials, and at any given point in time, you have raw material inventory. Then you have the product as it's moving down the conveyor belt that it's not quite done, and that's called work in process. And then you have the final finished good. So I think the car manufacturer is a good one to keep in mind as you're thinking about this. Objective 2, describe the value chain and its elements. The value chain is activities that add value to products and services and cost money. So there are many activities that are embedded in manufacturing something. R&D, design, production, purchase. So think about pharmaceuticals, for instance. There is a ton of money in R&D, and that's why pharmaceutical companies say that they have to charge so much for drugs. Whether you agree with that or not, they do spend a lot of money in R&D. And then they, the design, and then they produce the actual pharmaceutical. Then there's marketing, distribution, and customer service. So this is the value chain. So this is quite a bit different thought process than accounting, where you're just recording transactions as they occur. Okay, so if you want to look in your book and you want to look at E216A in Chapter 2, we're going to go through an example. They want you to talk about research and selling, purchase, and rearranging store layout from the information that you were provided in the chapter. So research and selling, satellite radio service is an R&D. Purchase of merchandise is a purchase, and rearranging store layout is a design. So here you have to stretch your mind a little bit in managerial accounting, where you have to think about lots of different activities and which bucket you want to put them in. And there, in real life, some of the buckets the lines are muddied. Newspaper advertisements, depreciation, payment to a consultant. Well, newspaper is marketing. Depreciation expense is a distribution because it's the delivery truck. That's why it's distribution. Payment to the consultant for advice on location of a new store. Think about that one for a minute. That's R&D. Always look for the words new, projection, forecasting, things like that. That'll help you get to the R&D. Freight in, salesperson salaries, customer complaint. Well, freight in is getting ready to get that purchase, ready. Salesperson's salary is marketing because the salespeople are part of the marketing department. And customer complaint department is customer service. Hopefully that helped you in preparation for your homework. Distinguish between direct and indirect costs. A cost object is anything for which managers want a separate measurement of cost. And what's really interesting in the real world is most companies spend a decent amount of money on their financial accounting system, but very few have good cost accounting systems. So we find ourselves doing cost accounting in Excel or other products. So let's talk about direct cost and indirect cost. So managers need to understand the difference between direct cost and indirect cost. So let's turn to S2. 4, which is also in chapter 2, if you want to follow along in your book. Let's look at the wages of store employees, the cost of operating the corporate payroll department, the cost of carpet steamers offered for rent, and the cost of gas and oil sold at the store. The wages of store employees are direct because the store employees are directly handling the product. The cost of operating the corporate payroll department is indirect. Any corporate function is indirect. Now you could argue that big companies have large corporate overhead, and if you were a little company and you had to do everything just for one branch or one division, that it would be easier to identify it towards a product. But when we talk about corporate anything, no matter how big or how small, it is considered indirect. The cost of carpet steamers offered for rent, oops, that one didn't come in, is direct because you're actually using this, this is part of your product, so it's a direct cost. And then the cost of gas and oil sold at the store is direct cost. Store utilities, once again, there's that store thing, so it's not administrative utilities, it's store utilities. The cost of chainsaws offered for rent is a direct cost. The cost of national advertising is indirect, because it's not a focus on one product, it's just a national marketing campaign. And then the CEO's salary is indirect too. Is the CEO not important? No. Indirect does not mean not important. It means that it's an overhead, and overhead costs are indirect. Okay, let's talk about Objective 4. There are two definitions of product cost. Total cost, which are used internally only, and we'll see this in later chapters. And then there's inventoriable product cost, used for external reporting. Inventorial product cost, let's get all the little pictures up here. You have your R&D, and then you have your design, and then you have your production and purchases. Those are your inventorial product costs. They all lead into that production event. Then you go to marketing, and then your distribution, and then your customer service. So inside of your inventorial product costs are sitting in your production and purchase phase. Period costs are all the costs incurred in the other stages of the value chain. So you have your customer service, your R&D, your distribution, and your design, and your marketing. These are your period costs. Inventorial product costs for the merchandiser. You take your purchase price from the suppliers. You add your cost to get ready for sale. You add your freight in. You add your import duties. Direct materials, direct labor equal direct costs. So in your book, you're going to start seeing things abbreviated. So keep that in mind. Then you have your manufacturing overhead is an indirect cost. So your direct material and your direct labor are direct costs. Your manufacturing overhead is an indirect cost. That word overhead is starting to be used a lot, and that should clue you in. Manufacturing overhead is indirect costs related to manufacturing that are not direct materials or direct labor. So we're really delving down into the layers of cost. Indirect materials, indirect labor. Those are manufacturing overhead. Other indirect manufacturing overhead. So of course we're going to do a problem, and you're going to be able to see some variations here. So let's look at S27. It helps to put numbers to things. The company's president's annual bonus is a period cost. Once again, that president is overhead. Plastic gallon containers in which milk is packaged. That's a product or a direct material cost. Depreciation on marketing department's computers. Okay, that's period because marketing department was a period. Wages and salaries paid to the machine operators at the dairy processing plant. Well, they are directly related with the product, so it's direct labor and it's a product cost. Research and development on improving milk pasteurization process. Well, that's part of what you do, so that's a period cost. Cost of milk purchased from the dairy is a product cost. So here you have your R&D, and here you actually have the cost to produce it. So that's the difference between the period and the product. Lubricants used in running bottling machines. Product cost. Manufacturing overhead. Depreciation on refrigerated trucks used to collect raw milk. Product manufacturing overhead. So you can see, depending on what you're manufacturing, you might have a lot of different line items that represent a product cost. Property tax on the dairy processing plant is a product cost, whereas property on the administration building would be a period cost. Television advertisements for Dairy Plains products is a period. Once again, it's marketing. Gasoline used to operate refrigerated trucks used to deliver finished dairy products is a period cost. Prime and conversion costs. Let's put them all up here. Okay, your prime costs are your direct materials and your direct labor. Your conversion costs include your direct labor and your manufacturing overhead. So direct labor sits in the middle here, and it goes between both buckets. Direct and indirect labor costs include salary and wages, fringe benefits, payroll taxes, and those are the main ones. So let's go to objective 5. Prepare the financial statements for service, merchandise, and manufacture companies. So we know how to prepare financial statements for service businesses, but let's move on now. The income statement for a service company. It's the simplest income statement. All costs are period costs. Service revenues minus operating expenses equals operating income. We learned this in financial accounting. The cost of goods sold calculation for a merchandiser was beginning inventory plus purchases plus import duties or tariffs plus freight in equals cost of goods available for sale. So that's a refresher from financial accounting. Minus your ending inventory is your cost of goods sold. So turn to S29. They give you all the different pieces there and they say compute the cost of goods sold. So take a look at it. Based on the slide before, you have your beginning inventory plus your purchases plus your import duties plus your freight in, and that gives you net purchases at that point. Then you have your cost of goods available for sale. Okay, so you take your total purchases plus your beginning inventory is your cost of goods available for sale. Less your ending inventory is your cost of goods sold. So that should be somewhat of a refresher for you. The income statement for the merchandiser is sales minus cost of goods sold equals gross profit. Minus your operating expenses is your operating income. So turn to S210. Let's do a little refresher here too. There is your beginning inventory plus your purchases is your cost of goods available for sale. And sit back and think about this. You start with something, you buy more, and that is the total amount that you could sell if you were to sell everything. Then you subtract out your ending inventory, and that's what you sold. So your income statement is your sales revenue less your cost of goods sold from the previous slide is your gross profit less your operating expenses is your operating income. These become very important as we start working with ratios. Direct materials used calculation. Beginning raw materials inventory plus purchases of raw materials plus freight in equals materials available for use. Now remember we talked about there were 3 types of inventory accounts. So here's your raw materials. Minus your ending raw materials is your direct materials used. So here's your first inventory account. It's your raw materials. Now turn to S211. You have direct materials used as your beginning raw materials plus your purchases of direct materials plus any import duties or freight in gives you your total purchases. Subtract that from your beginning inventory and then, add that to your beginning inventory and you have direct materials available for use. Minus your ending inventory is your direct materials used. So it's the same concept. We're just using the word materials, raw materials, instead of total inventory. Cost of goods manufactured for the manufacturer. beginning work in process, so here's our second inventory account, work in process, plus direct materials used, plus direct labor, plus manufacturing overhead, equals total manufacturing cost to account for, minus ending work in process, is cost of goods manufactured. So the formula looks the same. It's just what type of inventory we're dealing with. So how to calculate? Your beginning inventory plus your net purchases equals your cost of goods sold plus your ending inventory. Because your work in progress goes in and it goes out. It's like a holding account. Then you have your cost of goods sold calculation. Beginning finished goods inventory plus your cost of goods manufactured equals your cost of goods available for sale. Minus your ending finished goods is your cost of goods sold. So here is your finished goods. So you started with raw materials, it became work in process, then it moved to finished goods, and the product is there. So turn to E225A. They give you the information of the direct materials used. And then you had to do a schedule of cost of goods manufactured. So once again, here's putting numbers to the information that we've been talking about. So your manufacturing overhead is your indirect labor, your insurance on your plant, your depreciation on your plant, your repairs and maintenance on your plant. It's all the overhead related to the manufacturing side of the house. Then that number comes up to your manufacturing overhead. So notice it's not the finance department, it's not the CEO, it is the things, the overhead things related to the manufacturing side of the house. So here's your cost of goods sold. You had your beginning finished goods plus your cost of goods manufactured, gives you your goods available for sale, minus your ending inventory is your cost of goods sold. Then you had to do an income statement for a manufacturer. Once again, it was the sales minus the cost of goods sold equals gross profit minus operating expenses equals operating income. So look at E226A, which is the continuation of 25. Here's your sales revenue with your cost of goods sold, gives you gross profit, minus your marketing expenses and your general admin. Notice these are your operating expenses, is operating income. Okay, let's talk about those product and period costs. A service company has no inventorial product costs, and all costs along the value chain are period costs. The merchandiser has their purchases plus their cost of freight, import duties as inventoriable, and their period costs are all the other costs except total purchases. The manufacturer has the direct materials, direct labor, and manufacturing overhead as an inventorial product cost, and all costs except those are period costs. The accounting treatment is inventory on the balance sheet until sold, immediately expensed for the period costs. That's a nice little slide. You might want to print these slides out. Manufacturing company's T accounts, beginning inventory raw material plus purchases minus materials used in work in process gives you ending inventory. I love T accounts. They still work in this in managerial accounting. Your manufacturing company's inventory accounts, work in process, same thing, beginning inventory plus your materials used from raw materials plus direct labor plus manufacturing overhead minus the cost of goods manufactured and sent to finished goods. So these slides really review it for you. Print them out and put them side by side. The math you're doing is the same. It's just for a different inventory account. And then your finished goods is your beginning inventory plus your cost of goods manufactured minus your cost of goods sold equals your ending inventory. Your balance sheet differences are the type of company. There is no difference in inventory accounts because there aren't any. The merchandiser has a merchandise inventory account, and the manufacturer has three: the raw material, the work in process, and the finished goods. Objective 6 is describe costs that are relevant and irrelevant for decision making. Controllable and uncontrollable are two new terms. Management can influence or change cost if it's controllable, and uncontrollable, management has nothing they can do about it. So if you're manufacturing something and the price of gas goes up and you use a lot of gas to manufacture fuel to do what you do, it's uncontrollable. Then there's relevant versus irrelevant. Relevant are differential costs, which are costs that differ between alternatives, and irrelevant are costs which do not differ between alternatives, or also called sunk costs, costs incurred in the past which cannot be changed. And finally, objective 7 is to classify costs as fixed or variable and to calculate total and average costs. A variable cost changes in total cost in direct proportion to the change in volume, and a fixed cost stays constant. So when you have a company, you have a certain amount of cost that's going to exist no matter how much product you make. And then at some point, to cover that fixed cost, then the more items that you sell, the variation of that will create your profit. And we're just going to start that concept in here. So here's your total sales and commissions, and then your total sales. So as you can see, this is a variable cost. Commissions is a percent of sales. Assume we pay 5% sales commission on all sales. The cost of sales increases proportionately. Total fixed costs stay constant. Total sales versus total sales salary. You have to have a certain number of salespeople to sell your product, so that becomes a fixed cost. Your total cost is your fixed cost plus your variable cost times the number of units. Here's an example. Fixed costs are $20,000. Your variable cost is $50 per unit. You have 100 units, so your total cost is $20,000 plus the 50 times 100, or $25,000. The average cost is total cost divided by the number of units, is average cost. The example, 25,000 divided by 100 units is 250 per unit. So that's an average cost, and you know that number looks different than the previous slide. The average cost per unit is not appropriate for predicting total cost at different levels of output. Marginal cost is the cost of making one more unit. And that is the end of chapter 2. Send me an email if you have any questions.